Howdy, folks. Let's take a quick little look at the CDSs. Remember them credit default swaps? Let's go over a quick little definition of them. Credit default swaps, CDSs, are the most widely used type of credit derivative and a powerful force in the world markets. The first CDS contract was introduced by J.P. Morgan in 1997, and by 2012, despite a negative reputation in the wake of the 2008 financial crisis, the value of the market was an estimated 24.8 trillion, according to Barclays PIC. In March of the same year, Greece faced the biggest sovereign debt, or default, the international markets have ever seen, resulting in an expected CDS payout of approximately 2.6 billion to holders. Read on to find out how credit default swaps work and how investors can profit from them. How they work. A CDS contract involves the transfer of the credit risk of municipal bonds, emerging market bonds, mortgage-backed securities, or corporate debt between two parties. It is similar to insurance because it provides the buyer of the contract, who often owns the underlying credit, with protection against default, a credit rating downgrade, or another negative credit event. The seller of the contract assumes the credit risk that the buyer does not wish to shoulder in exchange for a periodic protection fee similar to an insurance premium, and is obligated to pay only if a negative credit event occurs. It is important to note that the CDS contract is not actually tied to a bond, but instead references it. For this reason, the bond involved in the transaction is called the reference obligation. A contract can reference a single credit or multiple credits. As mentioned above, the buyer of a CDS will gain protection or earn a profit depending on the purpose of the transaction. When the reference entity, the issuer, has a negative credit event, if such an event occurs, the party that sold the credit protection and who has assumed the credit risk must deliver the value of principal and interest payments that the reference bond would have paid to the protection buyer. With the reference bond still having some depressed residual value, the protection buyer must, in turn, deliver either the current cash value of the reference bonds or the actual bond to the protection seller, depending on the terms agreed upon at the onset of the contract. If there is no credit event, the seller of protection receives the periodic fee from the buyer and profits if the reference entity's debt remains good through the life of the contract and no payoff takes place. However, the contract seller is taking the risk of big losses if a credit event occurs. Hedging and speculations. CDSs have the following two uses. A CDS contract can be used as a hedge or insurance policy against the default of a bond or loan. An individual or company that is exposed to a lot of credit risk can shift some of that risk by buying protection in a CDS contract. This may be preferable to selling the security outright if the investor wants to reduce exposure and not eliminate it. Avoid taking a tax hit or just some element exposure for a certain period of time. The second use is for speculators to place their debts about the credit quality of a particular reference entity. With the value of the CDS market larger than the bonds and values that the contract reference, it is obvious that speculation has grown to be the most common function for CDS contracts. CDS provide a very efficient way to take a view on the credit of a reference entity. An investor with a positive view on the credit quality of a company can sell protection and collect the payment debt, go along with it, rather than spend a lot of money to load up on the company's bonds. And an investor with a negative view of the company's credit can buy protection for a relatively small periodic fee and receive a big payoff if the company defaults on its bonds or has some other credit events. A CDS can also serve as a way to access maturity exposure that would otherwise be unavailable, access credit risks when the supply of bonds is limited, or invest in foreign credits without currency risks. An investor can actually replicate the exposure of a bond or portfolio of bonds using CDSs. This can be very helpful in a situation where one or several bonds are difficult to obtain. In the open market, using a portfolio of CDS contracts, an investor can create a synthetic portfolio of bonds that has the same credit exposure and payoffs. While most of the discussion has been focusing on holding a CDS contract to expiration, these contracts are regularly traded. The value of a contract fluctuates based on the increasing or decreasing probability that a reference entity will have a credit event. Increased probability of such an event would make the contract worth more for the buyer of protection and worth less for the seller. The opposite occurs if the probability of a credit default or a credit event decreases. A trader in the market might speculate that the credit quality of a reference entity will deteriorate sometime in the future and will buy protection for the very short term in the hope of profiting from the transaction. An investor can exit a contract by selling his or her interest to another party, offsetting the contract by entering another contract on the other side of with another party, or offsetting the terms with the original counterparty. Because CDSs are traded over the counter, OTC, involve intricate knowledge of the market and the underlying assets and are valued using industry computers programs. They are better suited for industrial rather than retail investors. Market risks. The market for the CDS is OTC. And unregulated, and the contracts often get traded so much that it is hard to know who stands at each end of a transaction. There is a possibility that the risk buyer may not have the financial strength to abide by the contract's provision, making it difficult to value the contracts. The leverage involved in many CDS transactions and the possibility that a widespread downturn in the market could cause a massive defaults and challenge the ability of risk buyers to pay their obligations and to the uncertainty. Let's go look at this a little deeper. So let's go back and look at go over it again. A credit default swap, CDS, is a financial swap agreement that the seller of the CDS will compensate the buyer in the event of a loan default or other credit event. The buyer of the CDS makes a series of payments, the CDS fee or spread, to the seller, and in exchange receives a payoff. If the loan defaults, it was invented by Blythe Masters from J.P. Morgan in 1994. In the event of the default, the buyer of the CDS receives compensation, usually the face value of the loan, and the seller of the CDS takes possession of the defaulted loan. However, anyone can purchase a CDS, even buyers who do not hold the loan instrument and who have no direct insurable interest in the loan. These are called naked CDS. If there are more CDS contracts outstanding than bonds in existence, a protocol exists to hold a credit event auction. The payment received is usually substantially less than a face value of the loan. Credit default swaps have existed since the early 1990s and increased in use after 2003. By the end of 2007, the outstanding CDS amount was $62.2 trillion, falling to $26.3 trillion by mid-year 2010, but reportedly $25.5 trillion in early 2012. CDSs are not traded on an exchange, and there is no required reporting of transactions to a government agency. During the 2007-2010 financial crisis, the lack of transparency in this large market became a concern to regulators, as it could pose a systemic risk. In March 2010, the DTCC, Trade Information Warehouse, announced it would give regulators greater access to its credit default swaps database. The CDS data can be used by financial professionals, regulators, and the media to monitor how the market views credit risks of any entity on which a CDS is available, which can be compared to that provided by the credit rating agencies. U.S. courts may soon be following suit. Most CDSs are documented using standard forms drafted by the International Swaps and Derivative Association, ISDA, although there are many variants. In addition to the basic single name swaps, there are basket default swaps, BDSs, index CDSs, funded CDSs, also called credit linked notes, as well as loan-only credit default swaps, LCDS. In addition to corporations and governments, the reference entity can include a special purpose vehicle issuing asset-backed securities. Some claim that derivatives such as CDS are potentially dangerous and that they combine priority in bankruptcy with a lack of transparency. A CDS can be unsecured without collateral and be a higher risk for a default. And we've seen that. Description: a CDS is linked to a reference entity or reference obligor, usually a corporation or government. The reference entity is not a party to the contract. The buyer makes regular premium payments to the seller. The premium amounts constituting the spread changed by the seller to insure against a credit event. If the reference entity defaults, the protection seller pays the buyer the par value of the bond in exchange for physical delivery of the bond, although settlement may also be by cash or auction. A default is often referred to as credit event and includes such events as failure to pay, restructuring and bankruptcy, or even a drop in the borrower's credit rating. CDS contracts on sovereign obligations also usually include as credit events repudiation, moratorium, and acceleration. Most CDSs are in the $10-20 million range, with maturities between 1 and 10 years. 5 years is the most typical maturity. An investor or speculator may buy protection to hedge the risk of default on a bond or other debt instrument. regardless of whether such investor or speculator holds an interest in or bears any risk loss relating to such bond or debt instrument. In this way, a CDS is similar to credit insurance, although CDSs are not subject to regulations governing traditional insurance. Also, investors can buy and sell protection without owning debt or debt of the reference entity. These naked credit default swaps allow traders to speculate on the credit worthiness of reference entities. CDSs can be used to create synthetic long and short positions in the reference entity. Naked CDSs constitute most of the market in CDS. In addition, CDSs can also be used in capital, structural, arbitrage. A credit default swap, CDS, is a credit derivative contract between two counterparts. The buyer makes periodic payment to the seller and in return receives a payoff if an underlying financial instrument defaults or experiences a similar credit event. The CDS may refer to a specified loan or bond obligation of a reference entity, usually a corporation or government. As an example, imagine that an investor buys a CDS from a AAA bank where the reference entity is Risk Corp. The investor, the buyer of protection, will make regular payments to AAA bank, the seller of protection. If Risky Corp defaults on its debt, the investor receives a one-time payment from AAA bank, and the CDS contract is terminated. If the investor actually owns Risky Corp debt, that is owned money by Risky Corp, a CDS can act as a hedge. But investors can also buy CDS contracts referencing Risky Corp's debt without actually owning any Risky Corp debt. This may be done for speculative purposes to bet against the solvency of Risky Corp in a gamble to make money or to hedge investments in other companies whose fortunes are expected to be similar to those of Risky Corp. If the reference entity, that is, Risky Corp, defaults, one of two kinds of settlements can occur. The investor delivers a default asset to bank for payment of the par value, which is known as physical settlement. AAA bank pays the investor for differences between the par value and the market price of a specified debt obligation. Even if Risky Corp defaults, there is usually some recovery. That is, not all the investor's money is lost, which is known as cash settlement. The spread of a CDS is the annual amount the protection buyer must pay the protection seller over the length of the contract, expressed as a percentage of the notional amount. For example, if the CDS spread of Risky Corp is 50 basis points, or 0.5%, 1 basis point equals 0.1%. Then an investor buying $10 million worth of protection from AAA Bank must pay the bank $50,000. Payments are usually made on a quarterly basis in arrears. These payments continue until either the CDS contract expires or Risky Corp defaults. All things being equal, at any given time, if the maturity of two credit default swaps is the same, then the CDS associated with a company with a higher CDS spread is considered more likely to default by the market, since a higher fee is being charged to protect against this happening. However, factors such as liquidity and estimated loss given default can affect the comparison, credit spread rates, and credit ratings of the underlying or reference obligations are considered among money managers to be the best indicators of the likelihood of sellers of CDSs having to perform under these contracts. Difference from insurance. CDS contracts have obvious similarities with insurance because the buyer pays a premium and, in return, receives a sum of money if an adverse event occurs. However, there are also many differences. The most important being that an insurance contract provides an indemnity against the loss actually suffered by the policyholder on an asset in which it holds an insurable interest. By contrast, a CDS provides an equal payout to all holders, calculated using an agreed market-wide method. The holder does not need to own the underlying security and does not even have to suffer a loss from the default. Even the CDS can therefore be used to speculate on dead objects. The other difference include the seller might, in principle, not be a regulated entity, though in practice, most are banks. The seller is not required to maintain reserves to cover the protection sold. This was a principal cause of AIG's financial distress in 2008. It had insufficient reserves to meet the run of expected payout caused by the collapse of the housing bubble. Insurance requires the buyer to disclose all known risks, while CDSs do not. The CDS seller can, in many cases, still determine potential risk as the debt instrument being insured is a market commodity available for inspection. But in the case of certain instruments like CDOs, made up of slices of debt packages, it can be difficult to tell exactly what is being insured. Insurers manage risk primarily by setting loss reserves based on the law of large numbers and actuarial analysis. Dealers in CDS manage risks primarily by means of hedging with other CDS deals and in the underlying bond markets. CDS contracts are generally subject to market-to-market accounting, introducing income statements and balance sheet volatility. While insurance contracts are not hedge accounts, may not be available under U.S. Generally Accepted Account Principles, GAAP, unless the requirements of FAS 133 are met. In practice, this rarely happens. To cancel the insurance contract, the buyer can typically stop payment premiums, while the CDS, the contract, need to be unwound. Risk. When entering into a CDS, both the buyer and seller of credit protection take on counterparty risk. The buyer takes the risk that the seller may default. If AAA Bank and Risky Corp default simultaneously double default, the buyer loses this protection against default by the reference entity. If AAA Bank defaults but Risky Corp does not, the buyer might need to replace the defaulted CDS at a higher cost. The seller takes the risk that the buyer may default on the contract, depriving the seller of the expected revenue stream. More important, a seller normally limits its risk by buying offsetting protection from another party. It hedges its exposure. If the original buyer drops out, The seller squares its position by either unwinding the hedge transaction or by selling a new CDS to a third party, depending on market conditions. That may be at a lower price than original CDS and may therefore involve a loss to the seller. In the future, in the event that regulatory reforms require that CDS be traded and settled via a central exchange clearinghouse such as ICE, TCC, there will no longer be counterparty risk, as the risk of the counterparty will be held with the central exchange clearinghouse. As is true with other forms of over-the-counter derivatives, CDSs might involve liquidity risk. If one or both parties to a CDS contract must post collateral, which is common, there can be margin calls requiring the posting of additional collateral. The required collateral is agreed on by the parties when the CDS is first issued. The margin amount may vary over the life of the CDS contract. If the market price of the CDS contract changes or the credit rating of one of the parties changes, many CDS contracts even require payment of an upfront fee composed of reset to par and an initial coupon. Another kind of risk for the seller of credit default swaps is jump risk or jump to default risk. A seller of a CDS could be collecting monthly premiums with little expectation that the reference entity may default. A default creates a sudden obligation on the protection seller to pay millions, if not billions of dollars to protection buyers. This risk is not present in other over-the-counter derivatives. Source of market data. Data about the credit default swaps market is available from three main sources. Data on an actual and semi-annual. Data on an annual and semi-annual basis is available from the International Swaps and Derivative Association, ISDA, since 2001, and from the Bank for International Settlements, BIS, since 2004. The Depository Trust and Clearing Corporation, DTCC, through its Global Repository Trade Information Warehouse, TIW, provides weekly data, but publicly available information goes back only 1 year. The numbers provided by each source do not always match because each provider uses different sampling methods. According to the DTCC, the Trade Information Warehouse maintains that only global electronic database for virtually all CDS contracts outstanding in the marketplace. The Office of the Comptroller of the Currency publishes quarterly credit derivative data about insured U.S. commercial banks and trust companies. Uses. Credit default swaps can be used by investors for speculating, hedging, and arbitrage. Speculations. Credit default swaps allow investors to speculate on changes in CDS spreads of a single name or a market. Indices such as the North American CDX index or the European TRAXX index, an investor might believe that an entity's CDS spreads are too high or too low relatively to the entity's bond yield and attempt to profit from that view by entering into a trade known as a basis trade that combines a CDS with a cash bond and an interest rate swap. Finally, an investor might speculate on an entity's credit quality, since generally CDS spreads increase as creditworthiness declines and decline as creditworthiness increases. The investor might therefore buy CDS protection on a company to speculate that it is about to default. Alternatively, the investor might sell protection if it thinks that a company's creditworthiness might improve. The investor selling the CDS is viewed as making a long on the CDS and the credit as if the investor owned the bond. In contrast, the investor who bought protection is short on the CDS and the underlying credit. Credit default swaps opened up important new avenues to speculators. Investors could go long on a bond without any upfront cost of buying a bond. All the investor needed to do was promise to pay in the event of a default. Shorting a bond faced difficult practical problems such as shorting was often not feasible. CDSs made shorting credit possible and popular because the speculator in either case does not own the bond. Its position is said to be a synthetic long or short position. For example, a hedge fund believes that Risky Corp will soon default on its debt. Therefore, it buys $10 million worth of CDS protection for 2 years from AAA Bank with Risky Corp as the reference entity at a spread of 500 basis points equals 5% per annum. If Risky Corp does indeed default after, say, 1 year, then the hedge fund will have paid $500,000 to AAA Bank, but then receives $10 million, assuming zero recovery rate, and that AAA Bank has the liquidity to cover the loss, thereby making a profit. AAA Bank and its investors will incur a $95.5 million loss minus recovery, unless the bank has somehow offset the position before the default. However, if Risky Corp does not default, then the CDS contract runs for 2 years, and the hedge fund ends up paying $1 million without any return, thereby making a loss of AAA Bank by selling protection has made $1 million without any upfront investment. Note that there is a third possibility in the above scenarios. A hedge fund could decide to liquidate its position after a certain period of time in an attempt to realize its gain or loss. For example, after 1 year, the market now considered Risky Corp's more likely to default, so its CDS spread has widened from 500 to 1,500 basis points. The hedge fund may choose to sell $10 million worth of protection for 1 year to AAA Bank at this higher rate. Therefore, over the 2 years, the hedge fund pays the 2.5%. $10 million equals $1 million, but receives 15%. $10 million equals $1.5 million, giving a total profit of $500,000. In another scenario, after 1 year, the market now considers Risky much less likely to default, so its CDS spread has tightened from 500 to 250 basis points. Again, the hedge fund may choose to sell $10 million worth of protection for 1 year to AAA Bank at this lower spread. Therefore, over the 2 years, the hedge fund pays the bank to 5%, $10 million equals $1 million, but receives 2.5%, $10 million equals $250,000, giving a total loss of $750,000. The loss is smaller than the $1 million loss that it would have occurred in the second transaction had not been entered into. Transactions such as these do not even have to be entered into over the long term. If Risky Corp CDS spread had widened by just a couple basis points over the course of 1 day, the hedge fund could have entered into an offsetting contract immediately and made a small profit over the life of the CDS contracts. Credit default swaps are also used to structure synthetic collateralized debt obligations, CDOs. Instead of owning bonds or loans, a synthetic CDO gets credit exposure to a portfolio of fixed income assets without owning those assets through the use of CDS. CDOs are viewed as complex and opaque financial instruments. An example of synthetic CDO is Abacus 2007 AC1, which is the subject of the civil suit for fraud brought by the SEC against Goldman Sachs in April 2010. Abacus is a synthetic CDO consisting of credit default swaps referencing a variety of mortgage-backed securities. Naked credit default swaps. In the example above, the hedge fund did not own any debt risk or any debt of Risky Corp. In the example above, the hedge fund did not own any debt of Risky Corp. A CDS in which the buyer does not own the underlying debt is referred to as a naked credit default swap, estimated to be up to 80% the credit default swap market. There is currently a debate in the United States and Europe about whether speculative uses of credit default swaps should be banned. Legislation is under consideration by Congress as part of financial reform. Critics assert that naked CDS should be banned, comparing them to buying fire insurance on your neighbor's house, which creates a huge incentive for arson. Analogizing to the concept of insurable interest, critics say you should not be able to buy a CDS, insurance against default, when you do not own the bond. Short selling is also viewed as gambling and the CDS market as a casino. Another concern is the size of the CDS market, because naked credit default swaps are synthetic. There is no limit to how many can be sold. The gross amount of CDSs far exceed all real corporate bonds and loans outstanding. As a result, the risk of default is magnified, leading to concerns about systemic risk. Financiers George Soros called for an outright ban on naked credit default swaps, viewing them as toxic and allowing speculators to bet against and bear raid companies or countries. His concerns were echoed by several European politicians who, during the Greek financial crisis, accused naked CDS buyers of making the crisis worse. Despite these concerns, Secretary of Treasury Geithner, a Commodity Futures Trading Commission Chairman Gessler, are not in favor of an outright ban on naked credit default swaps. They prefer greater transparency and better capitalization requirements. These officials think that naked CDSs have a place in the market. Proponents of naked credit default swaps say that short selling in various forms, whether credit default swaps, options, or futures, has the beneficial effect on increasing liquidity in the marketplace. That benefits hedging activity without speculators buying and selling naked CDSs. Banks wanting to hedge might not find a ready seller of protection. Speculators also create a more competitive marketplace, keeping prices down for hedgers. A robust market in credit default swaps can also serve as a barometer to regulators and investors about the credit health of a company or country. Despite assertions that speculators are making the Greek crisis worse, Germany's market regulator Boffin found no proof supporting the claim. Some suggest that without credit default swaps, Greece's borrowing costs would be higher. As of November 2011, the Greek bonds have a bond yield of 28%. A bill in the U.S. Congress proposed giving a public authority the power to limit the use of CDSs other than for hedging purposes, but the bill did not become law. Hedging. Credit default swaps are often used to manage the risk of default that arises from holding debt. A bank, for example, may hedge its risk that a borrower may default on a loan by entering into a CDS contract as a buyer of protection. If the loan goes into default, the proceeds from the CDS contract cancel out the losses on the underlying debt. There are other ways to eliminate or reduce the risk of default. The bank could sell, that is, assign, the loan outright or bring in other banks to participants or as participants. However, these options may not meet the bank's needs. Consent of the corporate borrowers is often required. The bank may not want to incur the time and cost to find loan participants. If both borrower and lender are well known and the market, or even worse, the news media, learns that the bank is selling the loan, then the sale may be viewed as signaling a lack of trust in the borrower, which could severely damage the banker-client relationship. In addition, the bank simply may not want to sell or share the potential profits from the loan. By buying a credit default swap, the bank can lay off default risk while still keeping the loan in its portfolio. The downside to this hedge is that without default risk, a bank may have no motivation to actively monitor the loan, and the counterparty has no relationship to the borrower. Another kind of hedge is against concentration risk. A bank's risk management team may advise that the bank is overly concentrated with a particular borrower or industry. The bank can lay off some of the risk by buying a CDS because the borrower, the reference entity, is not a party to a credit default swap. Entering into a CDS allows the bank to achieve its diversity objectives without impacting its loan portfolio or customer relations. Similarly, a bank selling a CDS can diversify its portfolio by gaining exposure to an industry in which the selling bank has no customer base. A bank buying a protection can also use a CDS to free regulatory capital. By offloading a particular credit risk, a bank is not required to hold as much capital in reserve against the risk of default. Traditionally, 8% of the total loan under base 1. This frees resources the bank can use to make other loans to the same key customers or to the borrowers. Hedging risks is not limited to banks, as lenders, holders of corporate bonds such as banks, pension funds, or insurance companies may buy a CDS at a hedge for similar reasons. Pension fund example. A pension fund owns 5-year bonds issued by Risky Corp with par value of $10 million. To manage the risk of losing money if Risky Corp defaults on its debt, the pension fund buys a CDS from a derivative bank in a notional amount of $10 million. The CDS trades at 200 basis points. 200 basis points equals 2%. In return for this credit protection, the pension fund pays 2% of $10 million, $200,000 per annum in quarterly installments of $50,000 to Derivative Bank. If Risky Corporation does not default on its bond payment, the pension fund makes quarterly payments to Derivative Bank for 5 years and receives its $10 million back after 5 years from Risky Corp. Though the protection payment totaling $1 million reduce investment returns for the pension fund, its risks of loss due to Risky Corp defaulting on the bond is eliminated. If Risky Corporation defaults on its debt 3 years into the CDS contract, the pension fund would stop paying the quarterly premium, and Derivative Bank would ensure that the pension fund is refunded for its loss of $10 million minus recovery, either by physical or cash settlement. See settlement below. The pension fund still loses the $600,000 it has paid over 3 years, but without the CDS contract, it would have lost the entire $10 million minus recovery. In addition to financial institutions, large suppliers can use a credit default swap on a public bond issue or a basket of similar risks as a proxy for its own credit risk exposure on receivables. Although credit default swaps have been highly criticized for their role in the recent financial crisis, most observers conclude that using credit default swaps as a hedging device has a useful purpose.